This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, and thank God for that. The Mumbai winters are here, I dare say.
Yeah, lovely.
What did you
Mumbai
just say?
winters.
What did you say, Prashant? Mumbai winters? Where? Where are you coming from?
Let me start. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. And yes, the Mumbai winters are here, Surabhi.
Again, I want to know
I
which
qualified
specific...
winters by prefixing Mumbai. So.
Even so, I really wonder which part of Mumbai precisely you're coming from this morning. But
it's not hot anymore. I mean, that's as good as it gets. So
that's actually true. You're not sweating that much. So I think
Agreed,
we'll
guys.
take that.
I mean, it was a little chilly actually, and I've been a Mumbaikar all my life.
Chilly?
So for me, it's pleasant weather this morning. But guys, we get through today's trading session. There's obviously big news coming in from the banking and financial space.
yeah.
And on Monday, when we come back, you know,
we're going to be celebrating India's World Cup win. So,
yes.
No, absolutely. I think it sort of will be that way. Hopefully that way. Well, let's just kickstart this program with what you need to know as we begin another session, as always. And I'll start with the global stuff. I'll get to the bank stuff in a bit. But, you basically had US yield peak, which was once again endorsed. What do I mean by that? I mean that once again, the markets got the idea got reinforced that maybe the Fed is done and next year rate cuts will start. I'll get back to that in just a bit from now. But that has essentially been the big macro driver for these moves that we've been seeing globally. For day on day, in terms of what happened, there was consolidation because, I mean, the US as well, we've seen large moves. The NASDAQ was flat. The Russell 2000, which is a small cap index, actually sold off about 1.6% or so. Data was weak, which is good news, when you're looking at rates and yields, etc. So weekly jobless claims actually rose. Industrial production fell by more than expected. And as a result, as a consequence of that, the US 10-year yield, bond yield, lost about 8 basis points to about 4.45%. So that is number one. In terms of, just the bond yield move. Markets noted, Mester, the Fed hawk, a traditional Fed hawk, came through and he seemed pretty reluctant to push back on the 2024 rate cut expectations. And that, I think, was pretty significant. This is somebody who's actually advocated hikes after hikes. And when actually asked whether, we actually will see cuts in 2024, he didn't say, no, we perhaps will need to hold rates higher for longer, etc. There was no pushback. So now, according to market pricing in terms of what Fed is likely to do, there is a 95 basis point worth of rate cut, which is priced in for 2024. So that's significant. Now, oil prices, that's the other big piece of this puzzle, right? Oil is down almost 5% to about $77.50 per barrel. That is very large for a single day. And by the way, there was no real news flow. There was no trigger or news flow which drove this 5% sell-off. And that's why many are wondering whether the oil market is giving us a very early sign of perhaps growth starting to slow down sharply. This is going to be debated for some time to come. Just to circle back to where we stand in terms of the Nifty, Bank Nifty, etc. The October high, the swing high for the Nifty was 19,843. At the day's highest point, we crossed that. Intraday, we crossed that, but then we ended under it. So that is basically the first level to kind of take out. Once we take that out, the all-time highs, etc., come into view. Support for the Nifty comes in at, I want to put out two levels. One is 19,530, which is nothing but the 50% retracement of the fall that we saw. And then you also have 19,470, which is the 40-day exponential moving average. So these are where supports come in. I think we need to be mindful of where supports come in as well, because the market's been so strong that everybody's focused on the upside. On the Bank Nifty, just to kind of come back, we ended lower yesterday. The RBI action, which we will detail out in some, and we'll continue to discuss that with guests, etc., is significant. And that perhaps will put a dent in banks, in NBFCs, and generally the sentiment for that particular space. So I think here, the first support comes in at 43,970. We closed at about 44,160. On the upside, of course, the 61.8% retracement, which is 44,700, will come into play. Mid-caps and small caps, they continue to sort of rally. The mid-cap index, by the way, yesterday made a new high, intraday high. The small cap index, of course, has been pushing and making newer highs every single trading session. So there is a fair bit to track. Global handoff, etc., is okay. Oil price, of course, is significant. Oil price drop is significant, and that we will take note of in terms of oil-sensitive names, etc. But the GIFT Nifty should give us an indication of how we are likely to start, which is neither here nor there, about 30-odd points lower this morning. Surabhi.
Prashant, absolutely. Yeah, I think today of all cues, I am looking at this bank action, RBI action, in close detail, as most of us are. Pull up the bank Nifty intraday. Remember, in closing bell, we were all wondering what happened. The market had everything going for it. And suddenly, bam, a minute, out of nowhere, that index completely collapsed. So I just want to kind of hark back to that. Can you get the Nifty bank chart up, the line graph up? It was just around 3 o'clock. So clearly, the market was sensing something. Now, the fall probably wasn't enough to pencil in everything that's happened because, as Prashant said, the action is fairly significant and, it's something that cannot be perhaps digested in just one session flat. The fall from the peak yesterday, Bank Nifty was at 44,400 and then it closed down at about 44,161. So, 300, 350 point fall, it's clearly not enough to digest everything that has happened. So what has happened? Now, let's get back to the graphics. What we've seen is that the RBI has come out and increased risk weights on unsecured lending. What does that mean? Risk weights have gone up on credit cards, on personal loans. There are some exceptions like education loans, etc. Housing loans, of course, have been left out. But largely on unsecured lending. And this was the pocket in the banking sector that was really flying high. We had the RBI governor, and on past several occasions, he kind of referred to it. There was a hint towards this, whether we need to monitor the unsecured portfolio a little more rigorously. Well, that's exactly what has happened. Not just this, so the risk weights have gone up by 25 basis points on the unsecured part. And this, by the way, is applicable not just to banks, but to NBFCs as well. Not just this, the lending that banks are doing to NBFCs, even there, the risk weight has gone up by 25 basis points. Of course, we'll have Abhishek and all the experts to detail out how, this plays out. But the large understanding is that this will, in all probability, slow down what was a fantastic high-yielding segment for a lot of these lenders, at least in the near term. So we need to see that. And of course, then capital adequacy requirements might go up for some lenders as well with higher risk weights. So we'll see how that plays out. For the year, in any case, the Nifty Bank has been the underperformer, right? This index has hardly moved, just about 2.5% for the year, the calendar year 2023. The Nifty has done much, much better. Yesterday, if you note, just before the bank fall, the story of the day was this huge wave of buying in IT. Now, that's the question. As money keeps coming in, and I'll get to the flows in just a second, can IT take on market leadership in any meaningful way? Someone will have to, hold the can as banks go through this painful period of pricing in what the RBI has done. Now, onto the flows, and they remain positive. So that's something to keep in mind. Again, second day of buying from the FII fraternity, decent buy number, close to about 950 crores. Domestic institutions were also buyers. So the liquidity flow is coming. Where will the money go? Can IT or maybe Reliance or maybe the consumer space that hasn't performed, can any other sector, make up for the pain that perhaps banks have to go through in the near term? But Nigel, I know you're looking at levels and the FII positioning as well. So tell us more.
Well, the three top points first. Once the banks and the financials, they were preparing for some kind of negative news. And that's why we did see that fall yesterday. The Nifty IT index and other heavyweights, they'll have to hold one end up. And the third factor is crude oil prices. They have seen a sharp downtake, and that's what will keep the bulls rather excited. Let's focus on the first point, though, on the Nifty as well as the India VIX. Now, yesterday, the Nifty ended higher, but you saw the VIX as well that ended higher. That's normally a word of caution that comes in there, and that's precisely the way it played out yesterday. But on the Nifty Bank, that's going to be the big focal point. So I want to pull up two charts out here. All through the session yesterday, we were mentioning this, that at around that 50 as well as the 100 DMA, the Nifty Bank, it's facing some bit of resistance. So, and that's from where it did a U-turn as well yesterday. It traded in that range and then it pulled down. You'll say that's the resistance level. What about support? Let's get the next chart up for you. You should get the 20 as well as the 200 DMA that comes up for you. That's at around that 43,400 odd mark. That's where the crucial support is. So these are the two important points on the Nifty Bank itself in terms of resistance as well as in terms of support levels. But at the start of the series, we were mentioning the FIs are net short. But don't be so worried. It's played out exactly in that way. So at the start of the series, we 1.5 lakh contracts, FIs net short. Just take a look at that number. They've gradually covered down their position, and now they're down to around 1.27 lakh contracts. So that's a big short covering we've seen. At the high, it was close to around 1.75 lakh contracts. So 50,000 contracts have covered out, which has definitely had an impact on the Nifty. And take a look at the impact. Well, at the start of this series, we said April wasn't so bad and they were net short. Well, in the month of November so far, for the series itself, they have outbeat actually what we saw in April. So good going, the big short covering has played out. Now let's get to the levels then. On the Nifty, there's one strike that was fairly active yesterday. And before we that actually, since you already mentioned about the FI flows, I'm looking at the net institutional flows. And the last two sessions, the average is around 1,400 crores, which is encouraging. In the series so far, there have been net sellers to the tune of close to 150 to 200 crores. So institutional buying has restarted, which is good. And also shorts are covering out. Let's get to the levels then right away. Options data, the highest open interest that you have is at around the 19,700 put. On the put side, you have total open interest out there. And the premium on an average, I'll say it's around 75 rupees for yesterday itself. So all those that are writing this particular strike, the crucial support is at around 19,625. And yesterday's high, that becomes the near-term resistance level. So those are the levels you're looking at on the Nifty. And as I said earlier, the Nifty bank, that's going to be important. It's likely to start off a little bit subdued. But the levels that you're looking at, till it holds that 20 as well as the 200 EMA, you'll say, okay, we're fine. And on the upside, you have resistance. It visited this level yesterday, the 50 and the 100 EMA. So that's the resistance up for you in the screen. The Gift Nifty suggests we pull back a little bit. Let's see how we go from there, because the Nifty bank and the financials, they were positioned for some kind of negative news that we saw overnight. Back to you.
Okay, all right. That's what we'll watch for, some of those key resistances that the Nifty bank will have to encounter. Let's kick it off then. We've got a couple of calls coming in. This one is on equities, and it's from Christopher Wood of Jefferies, who says, higher for longer. The consensus at the end of last quarter is now seemingly truly dead and buried, with the market reaction to the latest US CPI data in terms of a further rally in bond markets and renewed weakness in the US dollar. He says money markets are now expecting 100 basis points of easing next year, compared with 75 basis points before this data.
Well, you got Amit Sachdeva of HSBC, who says that the second quarter FY24 results were good and potentially strong festive demand in third quarter could be a key catalyst. He says now that inflation risks are not overly concerning, margin tailwinds may continue. US bond yields have softened, and a sustained earnings trajectory potentially puts India back into focus, even though the upcoming elections are likely to be a distraction.
Okay, let's get to money markets then. A view coming in from Lakshman V of Federal Bank, who says the rupee is again trading back in its familiar territory after witnessing volatility in the US dollar index, which recovered from its 2-month lows on the back of softer US CPI print earlier this week. He expects the rupee to trade in a range of 83.02 to 83.30 to the dollar for the next few trading sessions.
Well, in bonds, we have V. Lakshmanan, who says that bond markets traded positive, tracking US treasuries, which fell after softer US inflation for October. He says lower domestic inflation with fall in core CPI, also supported bond prices. He expects the 10-year benchmark bond yield to trade between 7.15 to 7.3% in the coming sessions.
Well, we've got a lot of stock specific action to track for you. We get to that in just a bit from now. But for the time being, we highlight all the top stocks that we're tracking for you. JSW Infra, SJVN, TVS Motors, DCX Systems, you have JSW Steel, all of them on the back of positive news flow. And add to the list, Brigade Enterprises. While on the flip side, financials, delivery, ONGC and MCX, they could be reacting to negative news flow.
Okay, well, Arin Sanger is our first guest on the program. He's managing partner at Geosphere Capital Management. Arin, great to have you with us here. Thanks very much for your time. We didn't speak over the last couple of weeks, so happy Diwali. Season's greetings from all of us here to you, to your family, to your team. It's a pleasure. Arvind, just describe to us the changed mood in global markets, because I think the CPI number has really done the trick for markets. It's convinced people, everyone, even the last holdout out there, that maybe the Fed is done, and perhaps what the thing to expect is cuts in 2024. That is significant, isn't it?
It is significant in isolation, but it is also something to keep in mind that if you're going straight from inflation to recession, then be careful what you wish for, right? The markets are celebrating that the Fed is done, and the markets are hoping that the Fed is going to be cutting. But if the Fed is cutting into a recession, the recession may cause a little bit of a hiccup in markets. Now, I think that this is a US-specific problem. It's not a global problem that a recession will have big global impact, because I do not expect a deep earnings recession in the US, but I do expect some kind of a recession. And so, yes, I think from a global risk-on standpoint, if we are at the end of the hiking cycle, and if it's going to be a mild recession, then I think, notwithstanding some short-term, turbulence, I think global risk-on could sustain. But I would still caution that a recession is not necessarily, the beginning of a recession is not necessarily risk-on. So we're seeing unemployment go up. We're seeing inflation come down. But, is it inflation coming down because they've licked inflation and we're going to have this Goldilocks, or is inflation coming down because we're having a recession? That's an important distinction.
Okay. Which one do you think it is, Arvind? Good morning.
I'm in the recession camp. Good morning, Sophie. I'm in the recession camp, but I'm also in mild recession camp. So, with some little bit of patience, I'm quite interested in buying high-quality companies which have good growth stories. And India certainly has a few examples of that. Of course, the financials are going to have a bit of a hit today from the RBI tightening some of the requirements. But I think that over time, good companies, we think there are many good opportunities that we can find, especially if you get a bit of a modest pullback in markets.
Hi, Arvind. Good morning, and good to see you in after a few days. Tell us, how do you see things shaping up, though, from the emerging market basket? You got a couple of numbers coming out of China this week itself. I don't know whether it was a flash in the pan, but some of those numbers, they beat what they were estimating. Do you think China in the near term could be a tactical play and maybe, outperform the Indian markets just in the near term? Or do you think you'd rather stick to the longer term? Fundamentally, India is a structural story and you stick here.
Yeah, I would say that I would stick to the fundamental story long term. China clearly is, President Xi made a trip to the US in the last couple of days, and has been wooing US businesses, met with President Biden. Clearly, China is feeling the heat of having been, maybe a little bit less friendly to businesses, maybe more of a, open economic fight with the US. And I think they're trying to tone it down because they do realize that economic growth is something they cannot ignore. So I think China, which is really disappointed on the economic front last year because of zero COVID, this year because of some tough actions that the government in China took, which were not very supportive economically, is going to try to turn things around. And I am optimistic that China will see better data in 2024 than in 23. So you can have a trading play on China. But I think fundamentally, I think India has a much better growth story. So you could see, I will never say never that you couldn't see a little bit of funds flow towards China. But I think given the domestic flows into India, even a modest amount of international flows going away should not cause a major pullback. But, we frankly wouldn't mind a little bit of a pullback to put more money to work in India. But I don't expect a major dislocation in India from any China optimism.
Arvind, I just want to go back to that point you made on, bank stocks and financials, basically, and the hit, as you call it. It really is, I guess, not the best Friday for this part of the market. My question really is, on the mindset. Banks have been underperforming in this market for the entire year now. So when you talk to, your clients, investors in your fund, is there any sense of sort of frustration? Could it be that investors are losing some patience, or are they sort of in it for the long haul? And what are you advising your clients when it comes to financials, whether it's banks or NBFCs in India?
Well, I think we've been fortunate to be in a couple of financials that have actually done well, but not the big banks. And I think that, in a complete economic cycle, you cannot have a full economic cycle, healthy economic cycle, without the banks participating. But I think you have seen some, signs of maybe too much risk-taking with too much retail unsecured loans. So I think the market has been worried about that. The RBI's action today should give some backdrop to, maybe more allowances being made for risks on that. But I do believe that, select financials will work. Some of the NBFCs, which are well positioned, will work, because in an economic cycle, there's no way that you can have a full cycle. So we have a few financials. We have luckily underweight financials, so it hasn't hurt us too much. But I would look for any pullback here to create opportunities, because we cannot bet on India while thinking that financials will, continue to be in the doghouse. That just doesn't happen.
Okay, Arvind, we'll leave it there for now. Thank you very much for your time. It's a pleasure, as always, having you here on CNBC TV 18. We'll take a quick commercial break here. A list of top stocks to watch lined up next, coming up in just a bit from now. Stay with us.
Welcome back. Well, the morning might see a bit of a cautious start considering global cues and this big news from the RBI that's come in. Let's boil this down to stocks then. Our entire team is standing by with the CNBC TV 18 list of top stocks to watch out for today. And first off the crease, of course, is who else but Abhishek. Big news coming in last evening, Abhishek. Fill us in.
Well, RBI has decided to increase the risk weight assets on unsecured lending mainly or on consumer lending. So in 2019 September, RBI had reduced risk weight assets on personal loans or, consumer loans to about 100% from 125%. So this time around, they have put back the consumer loan risk weight assets back to 125% versus 100% that they had it earlier. The biggest part is that the credit card, that segment has seen massive increase in risk weight assets. It will be now at 150% from 125% that was there earlier. Even for bank loans to NBFCs, that risk weight assets have been increased to 125% versus 100% earlier. So amongst banks, those who have a large exposure to credit card or unsecured lending is the likes of RBL Bank, IDFC First Bank, ICICI Bank, where the personal loan and credit card loans have been growing really on the stronger side. For NBFCs, the unsecured loans, X of MFI loans and the same loans for banks that they have mentioned in terms of gold, vehicle, etc. The risk weight will increase to about 125%. For credit cards, especially for NBFCs, they'll attract RWA of 125% from 100% that they had earlier. So the big impact will be for SBI cards, given the fact that 100% of the book consists of credit cards. Aditya Birla Capital, Sundaram Finance, Shriram Finance are the other lenders that you would need to watch out for in trade today, given the impact of rise in RWA or risk weight assets for these lenders. Back to you.
Okay, all right. Abhishek, thanks a lot for that. So banks and financial names in particular, namely SBI cards, will be under pressure today. But let's hop across to Vivek. He's here to tell us about JSW Infra. Hey Vivek, morning.
Well, good morning. It's a significant development as far as JSW Infra is concerned. The company has received the letter of award, something that the company was alluding to even in our earlier conversation with them. Now, the company will be developing the Kenny port in Karnataka, and the project cost is estimated at over 4,100 crore. Now, this particular port is, will have a capacity of close to 30 million tons per annum. The development, the concession agreement is for 30 years, and along with that, this particular project will actually help the company go ahead and meet its 300 million tons per annum capacity target that they have kept by 2030. Currently, the company has close to 158 million tons per annum. So this is a significant addition to its cargo handling capacity as far as JSW Infra is concerned. The other stock on our radar is SJVN. Some positive news flow coming in there. The company has received a PPA, a power purchase agreement, for a 200 megawatt wind project with SECI, which is the Solar Energy Corporation of India. So the company go ahead and boosts its renewable energy portfolio. The wind portfolio of the company now stands at 497.6 megawatts. When you're talking about the tariff of this particular PPA that has been signed, it is rupees 3.24 per unit. So again, some positive news flow coming in for SJVN as well.
Okay, Vivek, thanks very much for that. Well, delivery is the next one. There is a share sale scheduled. SoftBank, which is an investor, is planning to sell a portion of what it holds. Mangalam is here with details. Mangalam.
Well, that's correct. So what we understand is that SoftBank is planning to sell stake worth nearly $150 million in delivery via a block deal. If that happens, it would be shedding around 4% of the stake that the company holds. And what we also understand from the term sheet is that it would be at a discount of anywhere between 0 to 2.5% of yesterday's closing price. That was 414 odd rupees. But remember, yesterday's closing price itself is about 10% away from its 52-week high and a lot lower from its record high as well. The question is this one of many, or this will just be one for now? We have SoftBank, which holds about 14.5% stake in the company as per the latest reporting. So we see this deal go through, and thereafter, given the small discount, maybe the stock recovers after opening in the red. But the question, the overhang of the sale will remain.
Okay, let's see how this one plays out. Mangalam, thanks very much for alerting us about it. Sonal is watching out for a bunch of stocks as well. Sonal, morning. Which ones are they?
Good morning. Well, 4 stocks on my radar today. Let me start with TVS Motors, because now they have entered into a strategic partnership with Emil Frey for key European markets. It's basically a distribution contract or partnership that they have entered into for the market that is in Europe. We have DCX Systems, which approved fundraise yesterday, and it is up to 500 crore rupees. It would be via QIP or private placement, but the details are yet to be known apart from this. JSW Steel considering the demand and supply situation of iron ore in the country, they've gone ahead and withdrawn their application for the final mine closure plan submitted on 1st September 2023. So that stock is on our radar. And Brigade will be developing 2 million square feet with a gross development value of 2,100 crore rupees. This is in their core market, Bengaluru itself. So we'll need to see more details here, but looks like a good development here.
Okay, all right. Thanks a lot for joining in and giving us all of that. Well, let's hop across to Manisha. The big cue overnight was the fall in crude oil prices. Manisha joins us. Tell us about that as well as MCX. Morning, Manisha.
Morning, and thank you for that, Nigel. I'll start with the crude oil prices first. And we did see a 5% decline in the overnight markets. The crude with this is now trading at a 4-month low, and this is going to be a 4th straight week that you are seeing the crude prices in the red. Well, we have seen weak global demand and rising supplies that's weighing on. The U.S. inventories and the U.S. production are near record highs, and then the Chinese oil refining has seen a decline. The kind of data that we've seen come in from Europe and U.S. also have been slightly on the weaker side, and that continues to weigh onto the crude oil prices. But the big move yesterday also came in for the gold prices. While the global market saw 0.5 to 1% of gain, at one point in time at MCX, the gold prices hit an all-time high at 61,914. That lasted just perhaps a minute or two, and then we saw the prices decline yet again by nearly 1,100 rupees. Well, traders that I've been speaking to find this move as an aberration. There have been complaints, they told us, since afternoon about placing orders on the exchange, and this movement of 1,000 and 1,200 rupees in matter of minutes, they say has triggered many stop losses for some as well. The other thing is the volumes, which were also high during these trades. So I have reached out to the exchange over in the last night, and we are still waiting to hear back from them. But this is a big move that we saw come in for the gold prices on the exchange.
Okay, that's an interesting development, Manisha. We will, of course, keep touching base with you through the day. Let's see if there's any clarity from the exchanges on that move in gold. For the time being, let's quickly recap our list of stocks to watch, and quite a few of them. Starting first up will be, of course, the ones that have positive news flow. Those include JSW Infra, SJVN, TVS Motors, DCX Systems, and JSW Steel. Brigade Enterprises as well. On the green side, stocks that have negative news flow around them are Financials, Delivery, ONGC, and MCX.
Okay, take a short, quick commercial break here. We'll be joined by Ajay Bodke, who will take us through what he's making of things, specific stocks, banks, and financials, of course, top of mind. A little later after that, we'll also have the management of Bidla Corporation, who will discuss their second quarter earnings. So stay tuned. Lots coming up.
Welcome back. You're tuned into Bazaar Morning Call. Well, we've just listed out all the stocks that you need to track. We've also given you a trade setup. Let's get in Ajay Bodke, who joins us to help us out with some fundamental analysis. Hi, Ajay. Morning, and thanks so much for joining in. Well, the top sector in focus is going to be the banks and the financial names. They're going to start off on the back foot. How do you approach these? Would any of them be on your buying list at a particular level?
Good morning, Nigel, and thank you for having me on the show. I think the much needed and long overdue measures announced by RBI is essentially because the governor's plea for banks and NBFCs to go slow on unsecured personal loan portfolio, which have seen very rapid growth vis-a-vis the other categories of loans, has fallen on deaf ears. And that's why the RBI was compelled to announce these measures. Now, my analysis of various banks and NBFCs indicates that there are 4 banks which you need to watch particularly. The first is Axis Bank, where I think the exposure of unsecured loans is roughly 25.7%. And my concerns essentially stem because of there's been rapid growth in unsecured loans for the last few quarters. Their share of NBFC loans is relatively high compared to the other banks, comparable banks, and they have relatively lower capital buffers. The second bank we need to keep watch is RBL, which of course is the most impacted because the exposure that it has for unsecured loans is at as high as 32%. Credit card exposure is quite high out there. And the risk weights will increase will impact it quite substantially. Kotak is another that you need to keep a watch because incrementally, if you see last few quarters, the management has been focusing and guiding analysts that it will be focusing more on unsecured loan portfolio. So it can get impacted. And lastly, Bank of Baroda, where again, I think the exposure of unsecured loans is moderately high at around 15.4%, but it stands out among the other PSU banks. So these are the 4 banks that I will be concerned about. And the analysis shows that the impact in capital ratios across various banks ranges between, say, 35 basis points on the lower side to as high as 98 basis points. RBL is the highest, around, say, 84 basis points. HDFC Bank 72 basis points, and ICICI Bank 64 basis points. So all in all, I think it appears to be a grim day for the banks. And on the NBFC side, I think the impact is far higher because in case of NBFCs like SBI credit cards, 100% of the portfolio is sort of will get impacted, and it's the loans that it sources from banks also are quite high. I think at around, say, not very high, it's around 12%. But there, I think the necessity for capital raise also will be there because the capital tier 1 ratio will get impacted by as high as 4.5%. From 21%, it will fall to around, say, 16.5%. The other NBFCs which remain vulnerable, in my opinion, are Bajaj Finance, where the adequacy tier 1 ratio will fall from 25 to 22%, and Chola Finance, where it will fall from 17% to 16.4%. The ones that will remain relatively unscathed, M&M Financial Services, all the HFCs, and also to an extent Shriram Finance. Poonawalla Finance, lastly, Poonawalla Finance also has a very large exposure, as also Aditya Bidla Capital. So I think these are the names that we need to worry about.
Ajay, thank you very much. That's fantastic analysis and I think really, really helpful to our viewers. You just clarifying, you said for Axis Bank, the exposure of total unsecured is 25%, as high as 25.
25.7% is the share of unsecured loans by Axis Bank. And it is, for ICICI Bank is 20.7, for HDFC it is 23.2%.
Got it. So, I want to come back to NBFCs for a second, Ajay. Now, SBI card, the thing is the stock hasn't run up. It's not done anything this year. So, yes, it's a hit, but there's been so much of chatter and noise around this that perhaps that's not something that the market will be entirely puzzled with. But I want to talk more about a stock like Bajaj Finance. Yesterday, we had Bajaj Finance recover very smartly from the regulatory action that it received separately, for their digital lending products. Now comes this, fresh piece of news. How would you look at Bajaj Finance? Do you think this kind of a dip is a buying opportunity, or is it perhaps best to stay away for a bit?
I think I would tend to agree with your latter view. I would rather stay away and see the market sort of digesting the impact of the twin measures, the ones announced by RBI yesterday, which was quite out of the blue, and of course the one that's been announced today, which impacts to varying degrees almost all NBFCs, barring few. Like yesterday's measure, if I were to just look at Crude, I think there are nearly 7 lakh, roughly 7 lakh digital EMI cards issued by Bajaj Finance on a quarterly basis. Now, that's a quite large number. And the overall disbursements, as per my analysis, because of the RBI ban, should lead to a decline of between 0.5 to 1.5% of the total disbursements. And although the management has said that they expect the ban to be lifted in 6 to 8 weeks due to remedial measures that they want to aggressively roll out, the expectation is that the PAT possibly could get impacted by between 4 to 5%, if say 20 to 25% of consumer durable loans would get impacted by this RBI ban. So I think today's last night's news, I think, comes on top of this pretty concerning news, because with company like Bajaj Finance, one rarely expects these kind of harsh measures from the regulator.
Okay, got it. Ajay, just stay with us for a bit. We need to chat about one cement company, and then I'll want your view on the cement stocks as well. Mr. Aditya Sirogi, the CFO at Bidla Corporation, joins us on the show. Hi, Mr. Sirogi. Good morning, and thanks so much for joining in. Well, you came out with your set of numbers in the past week itself. The question is, what's the way ahead from here on? So could you tell us, for the year, you were guiding for around 15% volume growth. It looks like you're pretty much in line in the first half of the year, though there'll be some slowdown because of the festivities. So do you stick to that 15% volume growth? Point number one. And the second factor is the EBITDA per ton. For the first half of the year, it's still sub that 700 rupees. You were talking about 850 rupees. You're sticking to that?
Good morning, Nigel. Thank you for having me on the show. In terms of volume, yes, we are sticking to our guidance of 15% for the year. I think we are on track to achieve that. And in terms of EBITDA per ton, yes, our EBITDA per ton for the first half of the year was lower, but that was expected also, because various levers that we are expecting will pan out gradually over the course of the year. These include the higher volumes in second half of the year, slightly better realizations. We had some price increases in the month of October. We expect those to sustain in the remaining part of the year. Mukundban operations have been ramping up pretty well, so that will aid our profitability, coupled with the fact that we'll expect to start getting the incentive in Q4 of the year.
Okay.
And last but not the least, we have initiated various internal programs like manufacturing excellence under Project Shikhar, and achieving optimization in our sales, logistics, and marketing operations under Project Unnati. Those will pan out and aid to our profitability in the quarter.
All right. Mr. Sirogi, you had to call that point. So operating leverage will play out, your cost cutting as well, cost focus, as well as price increases. But 850 rupees means for the second half of the year, you'll do a number closer to around 1,000 rupees? Or are you saying for the second half of the year, you'll do 850 rupees?
No, 850, in the region of 850 is what we are targeting for the entire year. Not for the entire year.
That means second half of the year, you'll do around 1,000 rupees to get an average of 850.
Whatever it comes to, between 900 and 1,000, whatever that comes to.
Got it. Okay, we have cleared that. Well, since you mentioned Mukundban, sir, could you tell us how things are shaping up out there? I think you were doing 150,000 the last time, as of September. How do you see that ramping up? What will Mukundban's contribution be? And what is the EBITDA per ton over there?
Yeah. So in terms of both cost and volume, it's a very good story. I mean, in terms of volume, in fact, it is achieving our expectations. We had given guidance that we expect to exit this year by 2 lakh tons per month. We are now expecting that we will be able to achieve that level faster than that. And the costs are also continuously coming down by each quarter. So, each quarter, the profitability of that unit continues to improve. And on top of that, we expect to start getting the incentive also in that unit. So definitely Q4 will be the best.
Got it. Okay. All right. That incentive will definitely help your profitability. Just a quick question on the price increases. You're basically focused in central India. What is the price increase if I compare the average price in Q3 in comparison to Q2? How much is that increase?
In quarters, in the month of October, on an average, the price increase has been around 3%.
3%, and that's sustained.
Yeah.
Got it.
Yeah,
3%.
because of these festivities, there was some slackening, but now we expect the prices again to firm up.
So you're going to push through another price increase? If yes, by how much?
No, the prices that were increased in October, there was some slackness because of festivities. Now we expect to go back to the October level.
Okay, but you're not expecting to push through another price increase. You're saying that 3% is good enough for now.
In the immediate term, I don't think so, but definitely going ahead towards the end of Q3 and beginning of Q4, definitely I would expect some further price increase.
Got it. Final question then, sir, before we let you go. The net debt number in your books, that's worrying some analysts. You know, you have a capex plan. You're saying you're going to be setting up a grinding unit as well at an attractive number, the 400 crores odd. Could you tell us what is the peak net debt number? I want an absolute number, sir. I get that net debt to EBITDA sub 3 is what you've been mentioning in the past. The absolute number, what could it look like? The net debt number, and since now profitability is going to improve, say by the end of FY24 and FY25, what can your net debt number look like?
See, our current debt as of September was around 3,550 crores. We expect to end the year with debt levels around these levels. Okay. And with the EBITDA that we are targeting, so we will be comfortably below the debt EBITDA of 3, which is what we expect to achieve on a sustainable basis.
And by FY25, this debt has this debt peaked out? And by FY25, will you start deleveraging the balance sheet, say bring it to sub 3,000 crores? Is that a possibility?
We don't look at absolute levels as we have guided in the past. We look in terms of debt EBITDA ratio. Okay. We always maintain that we would like to have our debt to EBITDA ratio within 3. And that we continue to that. We keep getting guided by that ratio.
There are a couple of assets, I believe, that are on the block, and you're at 21 million tons. You'll be at post this expansion, and you want to get to 30 million tons. Are you looking at any of those assets?
Not right now, Nigel. I don't think we will be able to achieve that with the debt EBITDA guidance that we have maintained.
Got it. It's been good speaking to you, Mr. Sarogi. Thanks so much for joining in. So broad takeaways are volume growth of 15% is well and truly on. The EBITDA per ton will spike up to around 1,000 rupees on an average for the second half of the year. That's what will bring the average for the year at around 850 rupees odd. And inorganic growth is not something they're considering as of now, but debt will hold at around this 3,500 crore odd level. For the time being, we'll slip into a short break. You come back. Mitesh as well as Shrikant will join in to tell us their technical trades for today's session.
Okay, welcome back. There's 12 minutes to go for the pre-open session. We've got things which are looking, I think, flattish to slightly lower. The big news story, of course, is what the RBI has done with regards to unsecured lending, and we'll talk about that in greater detail. Mitesh and Shrikant are with us, as always, with us on Friday mornings. Gentlemen, good morning. Good to have both of you here. Mitesh, what's the advice and what would you do? Yesterday, we got a bit of a knee-jerk sell-off in the last 30-40 minutes of trade. We crossed that swing high, the October swing high, intraday, but then, we ended far off from that particular level. How are things looking? GIFT Nifty is implying a 40-point lower start.
Yeah. Morning, Prashant. So a couple of things, that zone of 19,850, which was also the October swing high, and there's also a falling gap, which was recorded on the 21st of September. So I think that is an important level. Also is the fact that with the last few days of rally, the intraday charts were near overbought and they had run away too far from their moving averages. So I think some kind of supply was expected. In fact, I did highlight these points. But it doesn't look like a market which is turning negative. So I think it will be a market which will be slightly choppy and consolidative. I would predict some kind of a range building up in the next few days. 19,850, 875 being the upper end of the range, and roughly around 19,600, 620, or maybe 50 points lower because we need to still go there, could be the lower end of the range. So I think the idea should be to try and look for getting into long trades closer to about 19,600 or just below it, and try to book profits as we approach closer to about 19,850 on the Nifty.
Okay, that's on the Nifty. Just very quickly, to get your take on the Bank Nifty, sorry, I missed that, Mitesh. What are the immediate levels to watch there, considering there's bad news coming in? So maybe the first support and the one below that then?
Yeah. Morning. In fact, I didn't cover Bank Nifty, so you didn't miss it. It was my mistake. Bank Nifty, I think, has a very important support zone around this 44,000, 43,900 area. So again, I suspect that that should be possibly the lower end of the range for the Bank Nifty. And closer to about 44,500, 600 zone is where I expect the upper end of the range. So I think, again, the Bank Nifty could also consolidate in the next few days. Today, we have some negative news for NBFCs and the couple of banking names. But I think broadly, if we don't break 43,900, I think we should be all okay, and we should again try to bounce back from those levels.
43,900, not too far from where we are right now. So let's see. Okay, Shrikant, morning. Same question to you. The indices first, Nifty and Bank Nifty. What's the outlook?
Good morning, Survi. Yeah, I think so, along with the negative news flow, there is some positive part that global macros are supportive, and because of that, we are expecting market to come under some buying support around 19,600, 650. So if we see the market is dropping or it is opening somewhere close to 19,600, as even Mitesh said, I think we should look for taking some contra bets in the market with a stop loss close to 19,500. But for the Bank Nifty, it was underperforming. It was not supporting when there was specific bounce back in the market. So there we are expecting further more correction. Maybe Bank Nifty may touch the levels of 43,500. But I think there we should look for taking some interest in bank stocks. But I think for NBFCs, yes, certainly it's a tough time. But for the Nifty, yes, close to 19,600, 650, we should be buyer in the market.
Okay, let's get to the picks as well then, gentlemen. Mitesh, what stocks would you trade?
I have all buy calls today, Survi. Just that tactical adjustments I have tried to do. On the buying side is HCL Tech, and Nifty IT had a good breakout day in the last couple of sessions. So HCL Tech is a buy with a stop at 1294 for a first target of around 1350. A buy on Berger Paints, which could be aided by the fall in crude. Would recommend buying here with a stop at 567.5 for a target of around 600. And then I have a buy on a couple of pharma names. Dr. Reddy, on a mild decline, say around 55.25, would recommend buying with a stop below 54.90, and a target of around 5600 can be looked at. And Apollo Hospital is a conditional buy. Once it crosses the intraday pivot and moves above the highs of 5360, buy then with a stop at 53.25 and a target of 54.50 is what I recommend.
Got it. Okay. Thanks a lot for that, Mitesh. Hey, Shrikant, what about you? What are the individual stocks you're looking at?
Yeah, I think the way there is a fall in the crude prices, we should look for Asian Paints, because the stock was falling consistently since last so many months, but now it is rebounding from the lows and there is like specific news flow for it. So I think the stock from here can go to the levels of close to 3250, 3300 sort of levels. At current levels, certainly it's a buy with a stop loss at 3050. And the other stock which we like is Dixon Technology, which is around 5425, 5430 levels. At current levels, it is forming some consolidation pattern, but based on it, we are expecting stock to move towards 5600 in the near term. So it's a buy at current levels with a stop loss at 5370. So Dixon as well as Asian Paints should be on the watch list and buying list.
Okay, Asian Paints may be additional fillip as well because of the cooling off in crude oil prices, so that will give it legs. Thanks a lot for that, gentlemen. We'll come back to you for your 9-10 call as well. But for the time being, Manoj Muralidharan joins us to tell us how is he viewing trade setup today and his derivative strategies. Hey Manoj, morning. Run us through your strategy, both on the index as well as individual stocks.
Good morning, Nigel. Nigel, this entire up move that we have seen, let's say from 19,400 odd to almost 19,800, that's on the back of short covering. So we believe that, generally the depth is more, the weighted average price of the short covering comes closer to 19,500 to 550. So there is a chance that the Nifty might dip closer to that. So that is the level where Nifty becomes a buy. So we would refrain from buying, and we expect this 23rd November, the weekly expiry, the Nifty to be in this 400 odd points, 19,500 to 19,900. So wait for that dip, at least a 150 odd points. That is where the Nifty becomes a buy. Now, unfortunately, for the Bank Nifty and Nifty, there is a ratio which is somewhere close to 2.24, and we believe that there is a possibility of at least a 43,500 where we might see some refrain. So again, the Bank Nifty selling a call option of 44,500 for this weekly expiry becomes a good strategy. Stock specific, we believe IT is doing good and HCL Tech would top the list. So I would second that as well. So closer to 1340 to 1348 as a target. We recommend buying it closer to 1305 with a stop loss of 1290. And from the finance pack, SBI Life, we believe that is a stock. There is good accumulation going on month. And this momentum can go on almost to 1380, 1390 as a target. We recommend buying it closer to 1350 to 55 with a stop loss of 1320 on that.
Okay, got that, Manoj. Thank you very much. Have a great trading day, and we will, keep in touch. We'll take a break on that. Not on the other side, we'll have the pre-opening rates. And also the big story of the day, this huge action that's coming from the Reserve Bank of India on unsecured loans, personal loans and credit card loans. What's the way forward for the financial sector? Rikin Shah, Vice President at IIFL Securities, will join in to talk about some of the implications. Okay, about 2 minutes to go before we start getting the first pre-opening rates, and expect, a lot of fireworks around the financials today for very obvious reasons. And that's exactly what we are going to focus on right now on this leg of the show. We have an analyst in-house. We'll have Abhishek joining in on all the brokerage views that have been pouring in. But first, let's kick it off with what the RBI governor has said on this issue in the past. And he's made repeated reference to the rise in unsecured lending, both at the bank level and the NBFC level. Let's hear his commentary, and then we'll start the analysis.
Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability.
Well, the governor talking about it on the 6th of October, the MPC. Well, Abhishek is now joining in to tell us what brokerages are making of this. Abhishek, take it away.
Well, Prashant, the RBI increased the risk weight assets for lenders. Now, brokerages have impacted the impact on capital adequacy ratio for various lenders. So, to begin with, amongst NBFCs, for SBI cards, that is, CLSA estimates 415 basis point reduction in Tier 1 capital. Axis Capital estimates 416 basis point impact on SBI card. BofA Securities estimates 466 basis point decline in capital adequacy ratio of SBI cards. For Bajaj Finance, Citi expects 190 basis points or even more impact on capital adequacy ratio. CLSA estimates 230 basis point impact on Tier 1. Axis Cap estimates about 240 basis point impact on Tier 1. For other NBFCs, we have Citi's estimate more than 100 basis point impact is seen for Piramal Enterprise. About 55 basis point impact is seen on L&T Finance Holding, and between 20 to 30 basis point impact is seen for CV finances like Shriram Finance and Chola Finance. So amongst banks, we have Citi's estimate with respect to the impact on capital adequacy ratio on account of RBI's move to increase the RWA. 40 to 50 basis point impact is seen for the likes of SDFC Bank, Axis Bank, Bank of Baroda and Federal Bank. Around 30 basis point impact is seen for the likes of SBI, PNB and AU Small Finance Bank. Less than 25 basis point impact is seen for RBL Bank, ICICI Bank, Kotak Bank and IndusInd Bank. Now, amongst fintech, CLSA says that the growth of fintech intermediaries like Paytm will get impacted, although it may not be a large impact. Back to you.
Okay, well, Abhishek, thanks very much for that. We have Jinay Gala, who is Associate Director, India Ratings and Research, joining us on the line to discuss the impact, of course, on what's happening. We also have Rikin Shah, Vice President at IIFL Securities, here in our studios to take us through what the implications could be. Guys, hi, good morning. Rikin, if I can come to you first. Something was expected on personal loans. We, by the way, here, I remember I'd done a panel discussion in August, back in August, and there was Mr. Jairam Sridharan of Piramal Finance, who I think for the first time on a public platform had said that there is a credit cycle coming for personal loans, unsecured loans. And then, of course, we'd kind of followed through that with the story, etc. So on personal loans, perhaps something was expected. But this seems to be bigger than that, right?
Sure. So thanks for having me here today. So as you rightly pointed out, the impact on the personal loan was well known and flagged in the market. What was not perhaps anticipated by the market was increase in the risk weights for the NBFC exposures of the banks as well. Credit card risk weights have also gone up. They were already at 125 for the banks. It's going up to 150% now. So from that perspective, the incremental negative surprise for the street would be on the NBFC exposure of the banks and the credit card risk weights also going up.
So, let's just take that step by step. I think everyone's trying to now grapple with, first of all, what's going to be the added capital requirement, if at all, because of higher risk weight. So let's deal with banks first.
Sure.
They have to deal with the personal loan exposure, credit card exposure, and the NBFC exposure. Who get hits the most?
Sure. So for banks, the way we think about it is that the impact is going to be on the three lines: personal loans, credit cards, and NBFCs. The NBFC lending of the banks is also meaningful proportion at 10 to 15% of the loans for different banks. So in terms of the exposure to these segments, for the banks, it is around 10 to 30% of their loans. And if we think about the impact on the capital, which is the CET1, it ranges anywhere between 50 to 100 basis points, even after taking into account the exposure on NBFCs.
Okay, so again, just to expand on that point, and for the sake of clarity, right now we're clubbing this. We're clubbing personal loans, credit cards, and the exposure to NBFCs. Who is at 30%? Which are the banks which would be, and therefore they're exposed the most? And then the follow-up question would be, then will they have to raise capital? Which are the big lenders?
So among the banks that we track and cover, the lenders where the exposure is higher to these segments will be your ICICI Bank, RBL, IDFC First Bank, SBI. This would be the top 4-5 banks among the banks who have highest exposure. And consequently, the impact on the capital will also be relatively higher. So they would be on the higher end of the range of 40 to 100 basis points that I spoke about. If you look at the NBFCs, the impact on the capital would be anywhere from 30 basis points to 450 basis points. It's a very big spectrum out there. On the higher end of the NBFC exposure, the impacted ones would be SBI Cards, Bajaj Finance and Poonawalla, where the risk weight increase would be higher and hence the CET1 impact would be higher.
So I guess, it's a three-part impact, right? Once it hits the tier 1, second factor, it could limit growth. And the third factor is the cost of borrowing, cost of funds as well are likely to go up. So, a lot of these stocks are going to be under some pressure, Rikin, today. So our audience will be wondering, is this providing a bit of a buying opportunity? If yes, are there select stocks that we will be watching out for?
Sure. So, before I enter the stock level discussion, what I would like to highlight is that we are focusing on first order impact right now.
Right.
The second order impact for the financials will actually be in 3 parts. First one is the growth slowdown for both banks and NBFCs. Please remember, these loans were growing at 25 to 40% for different lenders in the recent quarters. So that growth starts to slow down. In fact, there is already evidence that the approval rates for the existing to bank and new to credit customers have started going down for the last couple of quarters. And some of the NBFCs have already started talking about scaling back on the growth. So that's the first impact. The second impact is the higher cost of funding for NBFCs, because the banks, to protect their RORWAs on their exposure to NBFCs, they'll increase the pricing on the NBFC loans. Now, for NBFCs, 50 to 80% of their borrowings come from the banks. Right. And hence, any increase on the risk weights, on the pricing there, would result into higher funding costs and margins. And the third point is on the asset quality, where we believe that the asset quality impact at this point in time should be limited mainly for the fintechs, NBFCs who originate loans via fintechs,
right,
and some of the select banks.
So would you were wanted to answer the second point as well? Maybe you'll look at entering select stocks, few select ones.
Sure. Among the names, among the banks or NBFCs who have lower exposure to these segments and higher capital ratios would be the ones where we would be selectively more optimistic. What we prefer among the banks is HDFC Bank, IndusInd and Axis. Among the NBFCs, we prefer Bajaj Finance.
Okay, well, just as you thought that interest rates are starting to come off, etc., and NBFCs, it'll be a good cycle for NBFCs. There is a bit of a speed breaker, and maybe rightly so, right? The RBI has been worried about this for some time. Let's also welcome in Jinay Gala, who's been holding on. Jinay, good morning. Good to have you with us here, and thanks for waiting. Your first sense, you heard Rikin, and I'm assuming that your thoughts perhaps would broadly match, but are the implications in terms of system-wide loan growth, etc., much larger than what one would have assumed before what the RBI did yesterday?
Sure. Good morning to everyone. I think so this measure would definitely have some impact on the growth front. As you have seen, the NBFC growth was led by growing at around 18 to 20% in FY23, and the growth momentum was still continuing. And if you look at the unsecured credit growth to the total sanctions, that growth has been somewhere around 25 to 30%. So definitely the unsecured lending was fueling the growth for the sector, and this regulatory clampdown would definitely have some impact on the growth front, and also would also lead to rise in the borrowing cost for NBFCs, as it was highlighted in the earlier discussion. We see there could be a three-leg approach which could play out, where the NBFCs who have gained in size and scale of late, where if you see the growth rates of few large NBFCs has been around 25 to 30% kind of a growth rate, where those NBFCs' ability to mobilize incremental borrowings could come under challenge, where their share of the bank borrowings used to be around 30 to 40%, which incrementally we see could come at a higher cost, and that would definitely lead to rise in the overall cost of funding for the sector. And their ability to pass on this rising funding cost to the end borrowers would also need to be seen. So there could be definitely a margin pressure for both banks and NBFCs, as this segment was largely contributing to the delta on the margin front. And incrementally, we also see there could be a substantial rise in capital raising across banks and NBFCs, which could again lead, since there would be a capital consumption of around 25 to 50 basis points, varying across our rated issuers. And also a lot of the covenants are also getting built on the leverage front, where we see that there could be an incremental need by a few of the lenders to raise capital based on the current raise in the risk weights. So definitely the growth and the capital buffers needs to be monitored going forward.
Hi, good morning. I'm sure you're still doing your numbers. It's very early in the morning. But could you, help us put a number to it, just from a big picture perspective? Let's say if we're talking about total credit offtake across the banking sector, I don't know what that number was for you before this action. So say if it was 10, does it go down to 8? And the question is sort of hinged on the idea of whether credit offtake from the corporate side can make up for the slowdown that we are probably going to see on unsecured retail now.
Yeah. So on the overall front, on the growth side for the banks, I think so there could be some amount of pressure, at least by 100 to 200 basis points on the overall spectrum based on the current measure. Having said that, the growth, whether that growth could be filled by the corporate loan growth, I think so the environment for corporate lending is good, but definitely the margins which are available on the unsecured side would not be available on the corporate side. So that would lead to some amount of pressure on the margin front for the banks, who would be recalibrating their exposure towards the corporate side. And also, this unsecured piece also provided lot amount of free flow to the NBFCs, NBFCs and also on the banks, largely on the liability side. For the banks, the customers who are on the unsecured side would also bring in some amount of deposits and the liability front. That could also come under pressure as the sector is already witnessing a slowdown in the CASA ratios. Going forward, we see that pressure could further increase to a certain extent, which could again lead to rise in the funding cost and the cost of mobilizing of liability for banks and NBFCs.
You know, the last numbers that I have, it's basically banks, total banks, personal, and Rikin and Janae, you can confirm, but the total banking sector personal loan book stood at about 43 lakh crores, approximately 43 lakh crores. The unsecured percentage out of that was between 33 and 34%. Right? Of course, the total banking lending book is much larger. It's 140 lakh crores.
Sure.
But personal loan was about 43. And out of that, 33 to 34% is unsecured. Those are numbers from a few months back, but I think valid still. Abhishek is still with us, our internal banking expert. Abhishek, I mean, come in. You've been looking at this closely. You know, you've been on conference calls, listening to managements, asking questions. And bank and NBFC, everybody in the second quarter, the first question which has been posed to them was about the personal loan segment and, what's been happening there.
Well, yes, unsecured loans had been rising. Wanted to ask one question to Rinking. NBFCs moved away from money market to banks for borrowings over the last one and a half year as interest rates started to rise. So, they shifted to banks. How much will the cost of funds get impacted for these segment of lenders, given the fact that they'll again go back to money market where, the interest rates are already on the elevated side?
So Abhishek, a fair question. So at this point in time, if you look at the incremental cost of funding for NBFCs from bank borrowings or from the bond markets, it's pretty similar. In fact, the bank borrowings would be 20-30 basis points cheaper. But the bigger point here to make is now the banks will start raising the price on this loans given to NBFCs, because currently the risk weights on the NBFCs which are rated A and above is only 20 to 50%. Now, as the risk weights increase by 25 percentage point, for the banks to protect their return on risk-weighted assets, theoretically, they'll need to raise rates as high by 200-250 basis points as well. But our interactions with the banks and the NBFCs last night suggest that the increase would be to the tune of 50-100 basis points for the bank loans for the NBFCs.
Rikin, just very quickly, the numbers again. Margin compression across NBFCs, just the overall range, and for banks as well, just the margin hit that we're talking about.
So the margin hit will be higher for NBFCs and not as much for the banks.
Yeah.
The banks is a second order impact wherein the increase in the yields on the loans from unsecured, that benefit will no longer accrue to them.
Yeah.
But for the NBFCs, as I highlighted, if the funding cost on the bank borrowings increase by 50-60 basis points, and this bank borrowings are typically 40-50%. So we are looking at 30-40 basis points of margin impact for NBFCs if this rate increases were to happen.
So in a way, any sort of help from falling interest rates, future fallen interest rates gets nullified by this.
That's true.
Looks like it, right?
Yes.
All right. Thank you very much, Rikin. Very clear and very helpful.
Yeah.
Thank you for joining in.
Thank you for having me.
Thank
Thank you so much.
Appreciate it. And of course, Janae as well. Thank you very much for joining in here this morning. I think, guys, we're going to go into market opening with 1 minute to go.
And the rates are 1% down on the bank Nifty. That's the pre-open.
Yeah.
Nifty is down about 90 points in the pre-open. This is playing along expected lines. 500 points is the first dip. The larger stocks, Bajaj Finance 3% lower, SBI about 2% lower, HDFC Bank. So basically, financials on the Nifty are down between 1% and 3%. Now, if that's how it plays out and some buyers come in later, that'll be the bulls' best case scenario. But let's see if that indeed plays out. And the other question is, can IT still keep providing some support to this market? Well, Off we go, and it is indeed that 90-point dip that we are starting off with. The Bank Nifty is on 528 points. Let's look at the rates then. SBI down 2.5%, Bajaj Finance down 2.5%, FinServ is down about 2%, ICICI Bank, HDFC Bank are down between 0.5% to 1% apiece. Ditto for an IndusInd Bank or a Kotak. Basically, all your frontline banks are down between 0.5% to about 1%. Actually, SBI is falling a lot more, as Rikin also pointed out. They will have to look at a bigger hit because of the growth that they had seen in the unsecured portfolio. 3% down on State Bank of India. And a lot of the reports are indicating that probably they'll have to raise some capital buffers as well because of this development that's taken place. So SBI is the big hit. Let's see what's up on the other side. Okay, so the oil marketing firms, at least there's some good news there. Let's not forget, crude oil prices have literally collapsed overnight. So BPCL is up about 1.5%. Its peers, HPCL and IOC, also are seeing a fair amount of green. So that's on the positive side. I'm trying to see who can support. HCL Tech, there's some buying over there. Then the consumer stocks, Asian Paints, up and about a little bit. There's some buying on Cipla. But Nigel, I mean, I can't see, too much of clear leadership on the other side. I think the hope is that banks themselves stop falling and buyers come in for the financials themselves.
Well, I'll tell you what, Surbhi, from a bullish perspective, today is a far better opening from a bullish perspective than any of the other days. Why is that? Because the market gave you an entry opportunity. Every day we've been seeing the markets open higher. From the lowest tick, in fact, the Nifty is already up close to 60 points. The Nifty bank is up close to around 200 points, approximately 250 points actually. So today, the markets actually gave you an entry opportunity. Will this sustain? For the time being, the bulls have gone in there and they have lapped it up. Levels you're looking at, well, for the Nifty itself, the level that you're looking at on the downside is 19,625. That's the level I gave you earlier today as well, because the 19,700 put has a fair bit of open interest build up. And in terms of today's low as well, we have that number. That's 19,668. So that's the important one you should keep at. This market is now down only around 25 points and the Nifty bank is down 300 points. So let's see if this sustains. Stocks in focus, delivery, that large trade we were expecting, that's taken place. 2% equity changing hands out there. A few more notable movers today. JSW Infra, big order win. Stock is up close to 6.5%. AGS Transact, they won an order from SBI. So that stock as well is high. These are one of the top volume buzzers today. And HPCL, what a dream run the stock has had actually. In this month, the stock is up close to around 30%. I think we had a couple of analysts who joined us on the show. I think Ajay Vora as well was making this point yesterday. That some of these stocks, valuation-wise, well, it appears that bulk of the bad news is in the price. And Suzlon, again, top volume mover, up close to around 3%. Surbhi, you want to come in and
Yeah, no, I forgot to mention the financials beyond the Nifty. The big ones are getting the big hits. So SBI Card, need to pull up that stock. It's down about 6%. RBL Bank opened down around 9%. Buyers are already coming in. So it seems to be, the mindset seems to be a bit of buy on dips. Not sure if that lasts. Aditya Birla Capital is the other one that is supposed to take a big hit, as is Poonawalla Finance, 4%, 5% on these, down on these ones as we speak. But Prashant, I mean, I would say it's a bit remarkable because the market is trying to put up a very brave face. And I don't know, I mean, if it sustains here and if this is pretty much the extent of the hit or not. But given the news, it's just a 24-point dip on the Nifty now.
No, absolutely. I mean, this is, and that's a market for you. So, I was using this word for the bulk of the year, Teflon coating.
Oh gosh,
Teflon
so
coating.
true today.
And it is, absolutely. So let's just look at, just sort of widen the gaze in terms of what else is happening. The Bank Nifty, though, is down. Yes, I mean, although from the opening levels, I think we've come off quite nicely. We've bounced quite nicely. The open of the Nifty Bank was 43,656. We're at about 43,780. So yes, from the opening level, we've bounced quite nicely. It's a green candle. Although we are back at the 38% retracement levels of the entire fall. We had gone above the 50% retracement. So this is not, technically, it's not a great sign. But we'll see. These are just the first opening couple of minutes or so. Market breadth is very positive, almost 3:1, right? I mean, 1350 stocks are higher and about 500 stocks are lower. So looking good. JSW Infra is the top volume-led gainer across the board. Huge volumes on JSW Infra. And, the stock is at 216 levels. It came to the market at $150. And this is what, this is, I think, the second or the third month. Second month, I think, of listing. And it's done so well already. What else? Suzlon is up another 3%. Stocks rallying ahead. 44 rupees on Suzlon, looking good. BSE, that is Bombay Stock Exchange, that is up about 3.5%. Huge volumes this morning. Actually, out of the gates, you got volumes are not a problem at all. HPCL is up about 3.5%. Brigade Enterprises, look at Brigade, 6.5% on Brigade, looking good and rallying ahead. Solar Industries will come up on your screen. These are not stocks we mentioned at open, but just because of the sheer volumes of these right now, about 4% on Solar Industries coming through. DCX India, again, I mean, I don't recall mentioning this one right at the start, but it's got volumes and it's got price move, 4% on that one. Network 18 and TV18 Broadcast, both, of course, affiliated and, owners of the news network that you're watching right now. They went up very sharply yesterday and they're up today this morning as well. So this is a little bit of sense of what's happening in the broader market, broader space. And of course, I think on the downside, it is, of course, delivery with that SoftBank sale. And it's a long list of banks and NBFCs which are taking a bit of a hit. I think we've already mentioned the bulk of it. RBL is down the most. It's down 8% or so. And, Paytm is down about 3%. PNB, SBI Card, Axis, Bajaj Finance, etc., etc., etc. It's a long list. It's basically made up of that entire pack, banks and financial services. Nigel.
Beautiful looking screen.
Hey,
just
look at this.
I mean, we're down only 15 points right now.
Nigel is saying that I was mentioning banks and I said, well,
Mid caps in the green and the Nifty is down. Barely 12.
That's telling you the texture of this market, right? I mean,
you want to buy. You want to buy whatever negative news, any news you want to buy.
I mean, the screen is telling you that, you need to have your stop losses in place. But I think once we got past that, the 19,400 odd mark, we had a couple of good sessions. The bears as well, they'll be wondering, what do we do next? We're down less than 10 points now. And that's why this morning I made that point that, you need to maintain the long bias. And actually, today's opening was the best case for bulls because they got to enter. The other couple of days, you're wondering whether or not you'll get to enter. Look to buy the intraday dip. Here, Pat, in the beginning itself, we had the Nifty that was down 95 points in pre-open. And from there, it's bounced up. In fact, now it's 95 points in the low point of the day.
Absolutely. Today's morning bull crown really goes to the auto sector. And the bulls would really want to thank autos. All of those stocks are fired up right now.
But I have a sense today may be a little more complicated instead of... because
this is just the opening,
This is the opening. You got a bounce from the intraday low, but it's just the start. And, it's a Friday as well. Markets have done very well over the last couple of days, even in the US, etc. as well. So, yeah, I mean, while the macro tailwind is there, as we've been highlighting, if you're trading intraday, I mean, of course, you've got to be very nimble and watch moves closely. Mahesh Patil is with us, CIO at Aditya Birla Sun Life Asset Management Company. Mahesh, good to have you with us here. Thank you very much for your time. What's the prognosis? How's the health of the market looking, Mahesh? The consensus view has been it's large caps. The time for mid caps and small caps, the best for them is behind. But look at the price. I mean, the screen is telling you something else. So just wanted to start there in terms of how you're thinking about that. Because in a way, animal spirits in the market are back with increasing conviction that this big global rate hiking cycle is behind. And if the Fed does not hike and actually cuts, the bar for others to hike also actually goes up quite a bit. Go on.
Good morning. So you're right, actually, in the last couple of weeks, right, we have seen that, especially on the global front, the concerns which were there about interest rates, where they'll peak out, okay, what will happen over there, to what extent the rate will remain higher for longer. I think those are kind of, the concerns are receded. We have seen a risk-on rally a bit globally, and that actually puts a floor to the markets, right? So earlier, one was not sure where the market will bottom out. I think in the backdrop of what's happened globally, and now markets are very clear that the rate tightening cycle is behind us. I think we're seeing more money coming in and chasing the markets over here. And that has given a fresh leg of move to our markets as well as the global markets. Fundamentally, I would say that the overall earnings season also, which has come through, has been fairly decent. I mean, there have been some disappointments in a few sectors, like, for example, IT and consumer discretionary. But by and large, we have seen the earnings expectations for this fiscal year remains fairly intact. And that should be a good sign for the markets to really hold on and to consolidate. It's consolidated now for quite some time in this region. And I think overall, while we still believe that the large cap space relatively looks better because it's underperformed in the last. In fact, in the last 2 years, if you look at the really large companies, they have not really gone anywhere. And mid caps, small caps look to be slightly relatively euphoric, okay, because of the retail money which is coming in. But again, it's been going to be more stock specific in the small and mid cap space, right? The tail, okay, in the small and mid cap space, which has gone up, I think that's where one needs to be slightly worried about. Otherwise, fundamentally, the markets look fairly strong. I think a lot of sectors and companies are doing reasonably well. We've seen some recent, again, this move from RBI in terms of the banking and financial services sectors in terms of increasing the risk weightages. That's a tad negative, but I don't think that's really going to hurt the market overall momentum.
I get that, Mahesh, and I just reminds us of why the Indian banking sector has been so resilient in times of crisis, global storms, etc. It is because our regulator has been way ahead of the curve and has not shied away from taking action preemptively and then whenever it has been necessary. So kudos to the RBI for that. But having said that, Mahesh, what should the approach be? I mean, financials anyway, at least the big banks, they've been lackluster in terms of performance, and now you have these fresh headwinds, perhaps slower growth. What would your approach be to big banks? And then we'll talk about NBFCs.
Actually, if you look at while definitely there is some impact in terms of your CET1, the saying capital impact of around 50 to 100 basis points for the larger banks. But I think if you look at over a medium term, the larger banks would actually be a bit beneficiaries, I would say, because especially banks which are well capitalized and have raised capital recently, I don't think it should really impact much. On the growth side, while we think that the NBFCs could slightly get impacted more there because their cost of funds from the banks would go up. And to that extent, I think the larger banks, a lot of NBFCs were growing much faster, especially on the retail side and taking market share. I think that could probably turn a bit, and the larger banks could, in the end, do slightly better. So I think we're not negative on the larger banks, especially banks which are well capitalized. And I think the impact on growth also will be marginal. I think I don't think there'll be any impact on the profitability per se, because banks will tend to pass on whatever they can in terms of increase in the overall yields to the end consumers.
Hi, Mr. Patel. Good morning. Nigel on this side. When we spoke last, you were talking about this building products divisions could do well since the real estate sector is coming back in style. And as we speak, we also have crude oil prices that have dipped. So from the building products division itself, what all would you look at? Would you look at tiles, paint companies as well? Because as we speak, actually, Asian Paints is one of the biggest gainers. Your view out there?
Yeah, so we've been positive on the real estate sector. We've seen that this cycle is, after a long period, we've seen the cycle now move up. Overall, inventory levels in the industry are much lower. And there's a genuine demand, which is picking up. So given that, I think you will see the trickle-down impact on the building materials. Normally, it is with a lag impact because once the house is constructed, then you require some of these materials. And while currently the demand for some of these building materials is picking up, but not to that extent, we think that could improve in the next fiscal year. And here again, I think it will be, some of the tile companies, or whether it is the paint companies, or even later down the line, the consumer durable sector, because that is something which will come at the last leg of the overall cycle. That's a sector where I think you could see things improving going forward. Again, some of these sectors were impacted because of the increase in the raw material prices, especially gas prices, and to some extent oil. The oil prices which had moved up, I think kind of pull down on some of these prices, I think should benefit in terms of margin improvement. But I think the key is in terms of volume growth, which is still not up to the mark, I would say. And I think that should come back, I think, sometime in the next fiscal year.
Okay. All right, Mahesh, thank you very much. We will leave it on that note for this morning. Appreciate you joining in and giving us your view on the market. Have a good day. Let's move on to some corporate conversations then. Blue Star is on our radar. The company came up with a pretty good performance for the second quarter. Strong growth was seen on the top line and at the EBITDA line as well. Margins also expanded. We have with us Mr. B. Thiagarajan, MD of Blue Star, to talk about the second quarter and, of course, the outlook as we look at the second half of the year. Mr. Thiagarajan, thank you for joining in, and season's greetings to you. Hope you had a fantastic Diwali. Well, the Diwali was already showing up in your numbers, right? Whether we look at the top line growth, whether we look at the EMP segment or the UCP segment, margins expansion coming in. So tell us, your thoughts on the second quarter, and more importantly, demand trends and just the outlook that you've seen festive season on in the second half.
Good morning. It's a pleasure interacting with you. Season's greetings to you and your audience. Q2 was good, as you pointed out, but then we now look forward to Q3 and Q4 as usual. The festival season has been going on extremely well. It commenced with Onam sales in Kerala, where we grew by more than 100%. And so far, till last week, compared with the previous year, room air conditioner sales is up by around 30%. That is festival season to festival season up to Diwali I am comparing. It is good. The reasons are being asked why it should be so much of growth. I suppose it is the pent-up demand because summer sales, as you can recall, were washed out due to unseasonal rains. So there could have been a pent-up demand that is driving the sales. The second one is overall economy is doing well. People are beginning to buy the second and third air conditioners. And we witness consumer finance aided sales is close to around 50% now, which means people are availing that 0% finance scheme. As I had indicated in the past...
Sir, allow me to come in over there. Sir, I'm so sorry I'm interrupting, but since you brought this up, you've touched upon the hottest subject of the morning, consumer finance. And you led me to the question, so therefore I had to interrupt because that's where the RBI slammed the brakes. You feel this can impact demand now in the near term?
It is driving huge demand. Actually, tier 3, 4, 5 towns is 65% of the sales now. And the first-time buyers account for more than 90%. And we are also witnessing we don't have a data in the country as yet. The average age of the buyers are coming down. When the air conditioners, typically one would imagine it is bought the average age of about 40 years plus. Now youth are trying to buy, but they are probably buying for their parents or the families. And so there is significant shift that is taking place, whether it is consumer finance or credit card sales. The story is on as far as this category is concerned.
Okay. Mr. Thiagarajan, just sorry, could you give us a number? You would have the data. Sorry for pressing, but out of the sales that happen, what percentage comes from from these kind of financing schemes, which is unsecured?
Close to 50%, I said.
Yes, 50%.
50% of the sales comes from... wow.
Consumer finance.
So, Mr. Thiagarajan, then we'll get to the important question. Since the RBI is tightening the screws, you have already grown better than what the industry is growing at. And in the past as well, you have told us you'll grow at around 1.5 times, if I remember correctly. Do you think there's a risk to that growth now? RBI is going to be tightening the screws on some of these financiers. So, will that impact sales?
So, I'll put it like this. First thing is that it is not 50% growth. I said that we should be growing faster than the market, and we have demonstrated that. And my outlook for full year has been that the market will grow at least to 15%. We should grow by 20% at least. That's what I had indicated. I maintain that as of now because much of the sales will have to take place in February and March, closer to summer. So how the summer will build up, etc. The second thing is this happens to be the second largest category, I think, in consumer finance because two-wheeler, four-wheelers will be ahead of us. Now, indeed, there will be opportunities as well as threats for the financing companies. So they are in a better position to advise how it will go. But what had been happening is that the consumers are advancing the purchase. So in a 10 to 12 installments, they are availing. I am not from a consumer finance firm. I do not know the dynamics, how it will work. Usually, the dealers have gone ahead financing till around 7-8 years ago. Eventually, it moved to NBFCs.
Okay, but whatever might be the new contours as they emerge of the financing model, like you said, the reliance on credit cards and on NBFCs, which was as high, unsecured, as high as 50%, that reliance is going to reduce. We know that. So therefore, the question, sir, are you not anticipating a slowdown in sales maybe in the second half of this year or as we look at the full year picture of FY25?
Not at all. For the simple reason, the penetration levels of this category is just 7%. And there is, irrespective of what is going to happen, the CAGR of 10% is definitely possible. In between, there may be some bad summers as it happened. But the clear direction is this. The country will have to consume air conditioners.
Okay, all right. Mr. Tyagarajan, so you believe the category itself is growing and you're sounding confident and, you've maintained, I said 1.5 times what the industry grows, so roughly around, that's what you're indicating as well. Tell us about market share. I recall quite a few quarters ago, when you were saying we are heading towards 15% in terms of market share. So could you tell us by when do you hit this 15% mark? And also in deep freezers, I think you have a larger market share out there. I think it's late 20s. Could you tell us where do you see this number headed as well? So both on RAC as well as on deep freezers.
Our market share as of now is 13.75%. Yes. That's what I would estimate it at. 15% is the goal by FY25. I think they are on track. We will be able to do that. And without impacting the margin. So I had indicated that operating margin of 8 to 8.5% is the target that we have got. Once upon a time, we used to think this category is 10%. I don't think so. It may be 8 to 8.5%. The deep freezers, we have market share close to 30%. And that's a very fast growing category. And the CAGR there may be around 20%. The emerging trend there is smaller capacities are consumed in a big way, with the ice cream penetrating in tier 3, 4, 5 markets, which means 100 liter, 150 liter, 200 liter deep freezers. That's the focus area where we are indigenizing and expanding our manufacturing capacity.
Mr. Tyagarajan, I just come back to one other thing which we've discussed before, which is competition, right? The segment will grow, but just look at the sheer amount of competition out there, which is and newer players have come through, players with reach and distribution. How does that, does that make you want to moderate, what you'll be able to do, or no, you think you'll be able to sort of battle it out?
No, this is my 44th year of career. And all throughout, I have seen competition to be intense, worse than what it was. I do not think it is going to moderate at all. It will become much more intense for the simple reason the manufacturing capacity in the country has gone up by almost 180%, thanks to the PLI scheme. So if the capacity is expanding, whether the market will be able to support that. And I had stated this earlier, that the entire PLI money of around, for close to around 5,000 crores, it will be diluted in the pricing. So I think the products will become affordable, market will grow, therefore scale benefit will follow. Competition will be intense. I do not think that it is going to soften at all.
Well, as consumers, that sounds fantastic, Mr. Tyagarajan, considering that Mumbai has like 9 months of intense heat. We can do with more and more ACs, right? But just to round things up, again, pricing, let me flip that question and talk about margins, because your margins expanded in the second quarter. You're at 6.5%. So just give us an outlook on margins and also the capacity utilization level that you're currently operating at.
We are operating at around 90% capacity level, and I think phase 2 of Sri City will have to be implemented next year. So our target is we will hopefully cross 1 million units. Last year we were at 8 lakhs, 1 million units. That capacity is just touch and go. We will have to expand Sri City phase 2 next year, which means 3 lakh more units we will manufacture. As far as the margins are concerned, there is still a lot more work to be done in actually the product-related costing. As we discussed, the competition is going to be intense, and as we get into the season, a few more products in affordable range will be launched.
Okay, all right, Mr. Tyagarajan, very quickly, you briefly mentioned about the expansion at Sri City. I think you have earmarked close to around 650 crores of capex for the next couple of years. What should be the asset turn be from this particular capex that you're putting down?
So our thumb rule has been 7.5 times. If we invest 100 crores, 750 crores of revenue should be generated. That's how we look at it.
So this will be a good 4,000 crores then?
That's right. But over a 3-year period, right? The plant itself will be getting commissioned in about 18 months. So every 100 crores of capital invested in manufacturing, you can imagine around 750 crores of revenue should be generated. That has been the track record, that has been the thumb rule that we follow.
Okay, it's a pleasure, Mr. Tyagarajan. Lovely chat as always. Thank you very much, and we wish you all the best of luck. As you said, 40 years, competition has been worse, and you're ready for more going forward. Thank you very much for joining us with all of that, as always. And season's greetings, sir, from all of us here, to you, to your team, to your family. Thank you. We'll take a quick commercial break here. The market's absolutely flat. We got about 4-point change, but that, of course, masks the fact that from the opening level, we've seen a big bounce, and it is holding on so far. Look at the Nifty Bank as well before we take a break. And the Bank Nifty is still down, but 0.75% lower. So that's about 350 odd points cut. The interesting thing from that Blue Star chat is we are talking about sort of, first order impact from what the RBI has done. But Mr. Tyagarajan gave us a glimpse of second order, third order impact as well. Consumer durables, which as a category, by the way, has been hurting for the last couple of years in any case. I'm especially talking about white goods. And it was surprising, I think, to all of us here in the studios that 50% of, the ACs that Blue Star sells comes from zero financing schemes and, personal loans. The unsecured segment, which what the RBI has now raised the bar for. So it'll only be known, of course, a couple of quarters down the line whether there is a bit of a hit which comes through that channel. For Blue Star and, of course, for other companies as well. So, worth watching out for. Delivery, that trade has gone through 2.5% equity has changed hands. We've been highlighting that since the morning. We take a quick commercial break here. We are back and we keep it with, of course, this big story from last night. Jairam Sridharan, Managing Director at Piramal Capital and Housing Finance, will join in. We'll also have the management of Bank of India joining in to discuss the impact of the RBI crackdown on unsecured lending. Stay with us. Okay, welcome back. You've got the market, which is doing well, actually quite well, 10 points higher and off the lows by quite a bit. Let's talk about the big story, which, of course, is the RBI crackdown on unsecured lending, which came through. Jairam Sridharan is Managing Director at Piramal Capital and Housing Finance. He's joining us now. Jairam, good morning. Great to have you with us here. Thank you very much. We also, by the way, have Mr. Rajneesh Karnatak, who's, of course, head at Bank of India. Mr. Rajneesh, great to have you with us here as well. Thank you very much. Prashant this side. Jairam, if I can come to you, we discussed this, back in August when on that panel you said, and I think a lot of people sat up and took note when you said that there is a credit cycle coming for the unsecured segment. I remember, later that week there was an RBI meeting and the RBI actually discussed that with NBFCs, etc. And it's been on the radar for NBFCs. We've reported that through stories, etc. What the RBI has done last evening, Jairam, would you consider, is it a little bit more than what you expected? Because many are saying that they were expected something on the personal loan side, but of course this NBFC bid, we're lending to NBFC, that was unexpected. Your thoughts in terms of the severity of the move? Go
on. Thank you, Prashant, for having me. I would say that this is a good positive move on the personal loan side. It's a good positive move for the industry. It does have some impact on growth in the short term, but that's okay. There's a little bit of bitter medicine, which is kind of time now and then. It's kind of necessary for the system to make sure that everything is healthy. See, back in September 2019, risk weights for personal loans, etc., used to be 125%. It was always 125%. It was brought down to 100% a few years ago. Frankly, around festive time, and festival season was weak and kind of growth was flagging, etc. And this was one of the ways in which that was given a fillip. However, we are in a completely opposite situation now. Growth has been on a tear, and as you and I have discussed in the past, there have been, in my mind, some excesses in terms of how much unsecured lending has happened. So it does need a little bit of bitter medicine. And in that sense, we certainly welcome the move of the regulator to actually do this, which is in the good long-term health of the industry, even though it might be somewhat painful in the short term. That's on the unsecured side. The NBFC side, as you said, RBI has been talking about this interconnectedness between the banking sector and the NBFC sector over the last few months. It's a relatively new theme. It's not something we have heard that much about in the past. And one way to reduce interconnectedness is to actually find ways to dampen enthusiasm of one sector lending to the other, which again theoretically makes a lot of sense. I think it is important to manage systemic risk. The question there is going to be, how do we ensure continued access to liquidity and continued access to funds for NBFCs as an important sector of the economy, either by enabling things like deposit licenses, etc., for large NBFCs,
right, or
some other such moves.
Right. Jairam, if you can broadly quantify in the ballpark, for the industry, and if you want to talk about Piramal per se, welcome to, but what could be the impact on net interest margins for NBFCs because of this move?
In the immediate term, Prashant, there will be none. Nothing will happen. The way these moves tend to take place is, see, today the banking sector's capital adequacy is super high, much higher than what regulatory requirements are. What this will do is it will bring down capital adequacy by, let us say, 50 basis points. For all the large banks, capital adequacy will be down 50 basis points. But they are so far above the basic requirements that 50 basis points isn't really going to pinch right away. So the immediate term impact of this type of medicine is not much. What tends to happen is slowly it trickles, and slowly the impact starts to come, and slowly on the margin people start asking for kind of higher pricing, etc., or higher returns on the capital deployed. So immediate term, I don't expect anything to happen, perfectly honestly. But yes, capital adequacy will come down right away by about 50 pips for most of the sector. And over time, people will try to ask for, let's say, 20 basis points higher, from, let's say, AA rated NBFCs, maybe. But that will be a long time, coming. For personal loans, the pricing is already quite steep. I don't really see the pricing changing, but yes, people's enthusiasm for it will go down. Boards will start asking questions, saying, "Hey, why are you doing so much? Because if RBI is not keen on this level of growth, etc." So that signaling value is a lot stronger than the actual numeric impact of what's going to happen.
Okay, interesting point there, Jairam. Well, let's ask the banker how he will look at both of these segments, right? We have Mr. Rajneesh Karnatak with us as well. So good morning. Thanks for joining in. So two-part question. First, what would be Bank of India's exposure to this segment? Unsecured loans, credit cards, along with your exposure to NBFCs. If you could just give us the number. And then what will your outlook be now when it comes to lending on both fronts, the unsecured side, as well as the lending you're doing to NBFCs?
Yeah, to answer your question in two parts, as far as the personal loans plus credit card is concerned, our book is around 7,500 crores as on 30th September. And if you ask for NBFC, then excluding the housing finance, our book is around 29,000 crores. So as far as the impact is there, as per the RBI circular which was issued yesterday, definitely there will be some impact because the RWA will go up. Because of the RWA going up, definitely there will be some shaving of the CRAR. So presently we are at having a CRAR of 15.63 as on 30th September. So it will be coming down as a ballpark number by around I think 30 basis points. That is the ballpark figure, though our risk department is working on the exact details.
So, okay, the second part to the question, sir. Also, if you could just give us the percentage of the book, it really helps. If you could just tell us that number on NBFCs. And the second part of the question really is, what's going to be the thought process? Like Jairam said, that maybe incrementally, banks might be a little hesitant, or maybe they, jack up pricing by 50 basis points when it comes to lending to NBFCs. So, give us your outlook as a banker. How will you look at fresh personal loans, if at all, and how will you look at the loans you're giving to NBFCs?
So presently our personal loan book, which is at around 7,500 crore, it is around 1.5% of the total global loan book. So that is not very significant, it's only 1.5%. So definitely the pricing will go up over there because of the increased cost of capital which is there now, which we have to provide because of the increased RWA. And on the NBFC side also, with 29,000 crore of outstanding as on 30th September, for NBFC other than housing finance, our book is around say 5 to 6% of the total global loan book. So that is also not very high, that is also quite moderate. So over there also what we see is that some pricing increase will be there for all A rated and above, in fact all NBFCs. So what RBI circular says, there will be an incremental 25% increase in the risk weight for all NBFCs which are A rated and above, A, AA and AAA. So typically A rated NBFC with a 50 RWA will become 75% RWA. So to that extent the RWA requirement will increase for all the banks, and so will be most likely the increase in interest rate.
All right. Hi, good morning, Mr. Karnataka. I was just looking at your book is approximately 5.2 lakh crore. So roughly around 6-7% approximately, put both these two numbers together, the 7,500 crores and the 27,000 crores that you're talking about. Tell us, but will this slow down the loan growth? What were you earlier estimating, and would you believe that now it will be a little bit slower?
Slowdown of loan growth will not be there, I don't think so, because it will be only a bit of increase in the price, that's all, because lot of appetite is there, incremental credit demand is also there, NBFCs are growing also very fast. In fact, the growth of NBFC is much faster than what is happening in the scheduled commercial banks. So growth will not be impacted, only thing is that some pricing increase will be there in these loans.
Well, that's interesting, Mr. Karnataka. So what you're saying is that you will not read this as a signaling sort of measure from the Reserve Bank of India, because that's the point that Jairam raised, that it's one aspect of how many basis points loans get pricier. The other aspect is the intent. So you're saying from a Bank of India perspective, you will not go slow on both the categories, personal loans as well as NBFCs?
No, it's not a question of going slow. What I am saying, the demand will be there. So demand will be there because the NBFCs have a good pipeline. So they are coming to the banks for credit also. So in that manner, the growth will be there as far as the NBFC is concerned, though it will be a tad low. That is what I am saying.
Jairam, we just had the management of Blue Star with us before you guys came on. And we were asking Mr. Tyagarajan about this. He said, well, 50% of his sales come from this, zero financing schemes, etc. But as we were discussing here in the studio, a lot of it would be also people who can afford to pay up the full thing and buy it buy it for cash, but who opt for these schemes because, it's just easier. Is that an important distinction when we look at the impact for on the consumer side, and especially consumer durables, etc., Jairam, or not really? What's the sense?
I think there is something to what you're saying, Prashant. I won't oversteer on that, though. Okay. You're right that consumer durables demand does depend a lot on unsecured lending, and slowdown on unsecured lending will impact it first. By the way, the specific part of unsecured lending which is most problematic, which is the small ticket unsecured, less than 50,000 rupees. Again, we have spoken about this in the past. That part is the worst impacted. And that's where the consumer durables play a lot. So RBI is clearly giving more and more signals to the industry saying, be careful about this segment. And I think the industry would do well to heed that advice and actually take a good hard look and make sure that we are doing things the right way. Demand in the short term, is so robust that a little bit of restriction of supply of credit, is not a bad thing. And I think that's why I say that as an industry, we should welcome this, because this is good for the long-term health of our industry, even though in the short term, you're right, it will it will impact things a little bit, and as it should. If your heart rate goes very high when you're running, you have to slow down your pace for the heart rate to come back to normal. That's exactly the sort of thing that's happening here, and it's absolutely the right thing to do.
No, completely agree. Jairam, so you're saying that the lower end, right, 10, 20, 50,000, up to 50,000, that's a segment which is most impacted. But there is also the space where fintechs operate. Most of the lending book is in that segment, right? Is that going to be problematic? I mean, will that ecosystem hurt quite a bit, disproportionately? Because, I mean, they rely on lending as a large source of income, many of them. Yeah.
See, you just heard Mr. Karnataka talk about how for Bank of India, the personal loans business is like 1.5% of their book, something like that, right? Similarly, in our case, let us say in Piramal's case, it'll be, let's say, 10% of our full book. Within that, even if I look at the small ticket personal loans, less than 50,000 rupee unsecured loans, that is for me kind of, let's say, 80 basis points of my full book, right? It's not a big deal. It's not that big an amount. But if you take an average fintech book, it could be like 70%, 80% of book, right? So what is 80 basis points of our book could be 80% of somebody's book. That's a really big deal then. Because if that part gets impacted, then really you are going to face some challenges. So you're right. The fintech ecosystem is probably going to see it a little bit harder, and depending on the book composition they have, it could be a lot harder than what full service banks or universal lending companies are going to see.
Mr. Karnataka, if I can ask you, when you make a loan to a NBFC, how much will the pricing on that go up by? Could it be all the way up to 50 basis points or not really? If you can give us a quantum?
So that is very difficult to ascribe at this juncture. See, when we are giving NBFCs typically which are A rated and above. So A, AA and AAA rated. So it all depends upon the pricing power we have and the negotiation which we have, and it's also commercial decision based on the market conditions. So all these things play out. So now with this increase in the risk weight which is now prescribed by RBI yesterday, definitely there will be some incremental increase in the rate of interest to the NBFCs, and more so for the AA and the single A rated NBFCs. Definitely.
You want to give us a range for Mr. Karnataka?
So maybe somewhere between 10 basis point to 40 basis points.
10 to 40 basis points, depending on how high NBFCs are rated.
The risk rating. Yeah, rating, whether it's a AAA, AA or A rated NBFC.
Got it. Jairam, you want to respond to that?
My view on this, Prashant, is that what you're going to see is that even further flight to quality. You have today AAA rated NBFCs starting tomorrow are going to be instead of at 20%, they're going to be at 45% risk weight. AA rated NBFCs are going to be at 55% risk weight. This is a much better situation than being in an A or an A minus or a triple B NBFC, where you're going to be near 100% risk weights now, or closer and closer to 100% risk weights. So the risk weight delta is going to bias you a lot more towards AA and A rated NBFCs, of which there are just a handful. There aren't that many. There are just 15, 20 NBFCs in the entire universe of AA and AAA, which essentially means the flight to quality towards AA and AAA is going to mean that all banks are going to want to lend to just those small group of people. And so my view is that AA and AAA rated NBFCs are going to have the bargaining power and the negotiation power to not take much increase in pricing, but below AA, where the number of NBFCs increases a lot, there it's going to be a lot harder.
Jairam, just one last question. Would you across the NBFC space, right? Because this segment, it's small for you. Also, it's small, right? But the point is, the growth rates were just through the roof. I mean, it was a very fast-growing segment, right? So should we moderate our growth expectations as we head into 2024? A loan growth across NBFCs broadly. I mean, of course, it'll vary, but is that the way to go? Go on.
I think overall unsecured lending growing at 30+% annually, etc. I think we should moderate that out. I don't think we are going to see that level of growth in the industry, and we have had that level of growth for 2-3 years now. So it's fine for the growth rate to moderate a little bit from there. So as I said, it's a good thing for the industry. What the regulator is trying to push us towards, and we should embrace it, and we should be okay with running a little bit slower.
Okay. All right. We'll leave it there. Jairam, great to have you with us here. Thank you very much for joining us. We sort of highlighted this back in August, and now, of course, this action, as you highlighted from the RBI, really putting the brakes, and it's a good thing, as you put it. Mr. Karnatik, it's a pleasure having you with us here, sir, and providing us your perspective, as a seasoned banker in terms of what this would mean for banks and NBFCs as well. Thank you very much, both of you, for joining us here on CNBC TV 18. Well, you got the market, just to take stock, which is up about 30 points. So it's actually getting better. 19,800 back on the screen. And, this is with no help from the banks, which are still languishing. The Nifty bank is off the lows by quite a bit. It's down 0.75% for the day so far. But we'll see. Mitesh is with us with a quick check on things. Mitesh, hi, good morning. What are you making of the trade so far? There is strength. There is resilience.
Yes. Morning, Prashant. So as I said, I think, the fall yesterday did not turn the trend on the downside, but just means that we'll take some effort and consolidation to get past 19,850, 870. I think prepare for a range between 19,850, 870 to about 19,600 broadly. And the Bank Nifty, I think, remains the worry. It is trading below 43,900, and if it does not manages to capture, these levels of 43,900, 44,000, then we might see the selling, spill over the next couple of days. So in that sense, I'll keep a close watch on the Bank Nifty. But the Nifty otherwise looks very fine, and especially the technology stocks, look very healthy. I have got 2 buy calls right now. Bosch is a buy with a stop at 20,400 for targets of roughly around 21,300. And the other one is Tech Mahindra, which I would recommend buying at slightly lower levels, so around 1,200. Buy with a stop below 1180 and a target of 1250 can be.
Okay, Mitesh, got that. Thank you very much. By the way, I need to highlight what's happening with insurance stocks. Not sure if there's some sort of a trade that's going on, away from banks and NBFCs, away from the lenders to some of the insurers. But these are massive moves. LIC is the least of them. Look at SBI Life, look at HDFC Life, look at ICICI Prudential, look at ICICI Lombard, look at Max. Life insurers are on fire. So I'm not sure if, bank and NBFC's loss is insurers' gain today. But this is a very, very curious trade that's playing out. Mitesh, and I don't know if you're still with us. Mitesh, can you hear me? I think we don't have him. Next time we have him on, we'll ask him about some of these insurance stocks and whether there's at least a short-term trade there or not. Right now, I need to take a very quick break. We'll come back on the other side and check out all the commodity cues for the morning. Welcome back. Well, the recovery continues in the equity market, barring banks. I mean, the equity market is a sea of green. That's the way this Friday has turned out. We haven't given enough importance to auto stocks, by the way. Should just point that out, along with this huge trade on insurers that's underway right now. Autos are very, very strong in or two-wheelers. That's the Nifty Auto Index. But let's move away from equities and now talk commodities. As promised, we have Manisha latest. Manisha, too much news in our markets. Tell us what's
credit to the crude price decline if the equity markets are doing well. And we have seen further decline come in for this one. So, you know, overnight we saw 5% of a cut coming in for the crude oil prices, and do not get in sense of a small green in the Asian markets right now, because we are at a 4-month lows, and this is going to be a 4th straight week of decline coming in for the crude oil prices. Well, every data, every event that has happened in this week has been putting pressure on the crude oil prices. To begin with, it has been about the weak global demand, the rising output and inventories that continues to weigh on. The China oil refining for the previous month fell by nearly 2.8% on a month-on-month basis. So the Chinese demand and refining clearly shows you that the demand is on the weaker foot there. The US crude output is at a record highs of around 13.2 million barrels. Also, the US inventories in last 2 weeks itself have surged by 17.5 million barrels. So we are looking at higher production, higher inventories, weak demand, all of that weighs onto the crude oil prices. And then there are various interesting statements as well coming in. You have IEA saying that they do not expect tight markets in 4th quarter as was earlier projected. There also is an interesting statement from ING which says that markets are expected to be in a bit of a surplus now by the 1st quarter of 2024. And that also led to decline. Interesting to watch would be the OPEC and allies meeting. That is on November 26. Whether or not they talk about further cuts and how do they support these markets is going to be quite interesting to watch out for. Having said that, we did see nearly 10% in the month of October from the crude oil prices, and we are down by yet another 8% for the month of November so far. And you know, this is a chart that I have been maintaining from the beginning of this year, and it only interesting. We started this year with $82 a barrel on the higher side. It was a sharp decline by the month of June with all the weak China data coming in, and we saw $70 a barrel. 96 came in September as we saw markets talking about a tight 4th quarter. Also, all of that led to prices to go to $96 a barrel. By the 5th of October, we had gone down again, $91 by October 16th. We did see some support coming into the prices, but as you can see in the month and from mid of October, it has been a one-side decline that we have seen come in for the crude oil prices. Well, markets do say that at 78 as well, it does not look a very strong buy right now. 78 was a target, is expected to be a strong support. But if that gives away, then 75 perhaps could be on charts pretty soon.
Okay, well, Manisha, thank you very much for that. So that's commodities in focus at this point in time. We'll take a quick commercial break here. We'll come back in just a bit from now. Markets doing just fine, at least on the Nifty. My colleague Lata will get an exclusive conversation with Gautam Dugar of Motilal Oswal Financial Services, and we review the 2nd quarter earnings, how they've been, how many above and below expectations. Stay with us.
Welcome back. We have discussed the new Reserve Bank of India rules and their impact on banks and NBFCs as thoroughly as we could. But as you can see, the stock market, barring banks and NBFCs, is actually up and away. Now, one reason why we've been doing well for the past several weeks is that we have put behind a very good 2nd quarter earnings. Now, how good was the 2nd quarter? I have with me Gautam Dugar of Motilal Oswal Financial Services to tell us just that. They have brought out an excellent report analyzing threadbare the growth in sales, EBITDA, margins, earnings, and how the second half may look. Gautam, thank you very much for your time. Well, what are your first opening comments on the 2nd quarter numbers?
Hi, Lata. Thanks for having me. Good morning and belated wishes for Diwali and season.
Thank you. Same to you.
This quarter has actually been very good, Lata. Not just in terms of the aggregate beat that we have seen for our coverage, Nifty, sensex, whichever way you look at and slice and dice the numbers. But most importantly, the participation has been very broad-based. In fact, this is one of the few quarters, I don't remember when was the last time I've seen that almost all sectors that we track have either beaten expectations or have met expectations, right? So 19 out of 21 sectors that we track have either met or have beaten expectations. Only one or two small sectors which marginally missed the expectations. In terms of absolute growth, we've seen 28% earnings growth for Nifty versus expectation of 21%. And for our broader coverage universe, we have seen around 50% earnings growth versus expectation of 40. There is obviously an element of OMCs which come into picture, but even if you exclude OMCs or exclude financials or exclude commodities, the numbers are far better than expectations. The margin tailwind is visible across the board. Second, we've seen an earnings upgrade for both FY24 and FY25, right? So our earnings estimate for Nifty FY24 EPS has been revised upwards from 986 rupees to close to 996 rupees now. And for FY25, also from around 1130 to 1140 rupees. So this has been a picture perfect earnings, I would say. And we've done segregation also, large cap, mid cap, small caps. All three segments of the market caps have beaten earnings estimate. And essentially what it does is it makes FY25 price to earnings ratio for Nifty looks very reasonable now at about 17.3 times. So that's a snapshot of the earnings led by domestic cyclicals like financials, auto, cements, So the trends have been pretty good there, and we have seen a good margin tailwind as well.
Okay, now this is very important what you say, that with the increasing of your earnings forecast, the price to equity, price to earnings actually looks reasonable now. At 17.8, we are one standard deviation lower than the long-term average, right?
Absolutely. So 10-year average Nifty P is about 20 times. Right now, if you look at FY25 EPS at about 1140, which is our current estimate, we are trading somewhere close to 17.5. Even if you take 4-5 earnings downgrade, you're still talking about 18 times, which is very, very reasonable. In fact, Nifty has been flat for 2 years. It's almost sort of a stealth bear market correction for Nifty.
That's a big takeaway that, we're frequently told, very high PE and Indian markets are overpriced, although the earnings is very good. But this is very important, that price to earnings are actually below their long-term average. Now, let me bring the most newsy part. We've got the new rules from the Reserve Bank. Will this make you change your earnings forecast to some extent? Because one understands the NBFCs, both margins and the quantum of loans can fall. So will there be some changes that you have to make?
Yes, obviously, RBI has been making frequent noises about their discomfort with the sharp growth that we have seen in unsecured retailing. Yesterday, they took the first step. Let us see how many more steps they take. I think corporates will also absorb what has just happened. There will definitely be some impact on the growth rates. It will result in some tinkering of earnings estimates for NBFC specifically. But I think the bigger impact will be seen in the valuation multiples, because some segments of financials, specifically the NBFCs, which are a growth play rather than a valuation play, if the growth gets tinkered a little bit or growth gets moderated a little bit here or there, I think the bigger impact can be felt on valuation multiple rather than just the quant impact of 3% EPS change or a 4% EPS change here or there. I think banks are comfortably placed, especially large cap private sector banks, and of course some of the big PSU banks as well, and which is what I think the early reaction of the market today is also portraying. I think the impact needs to be differentiated. First within sector, then within sector across different bottom-up companies, and company by company you have to look at what kind of impact it can have on cost of funds, what kind of impact it can have on their tier 1 ratios, whether there is a need for capital to be raised, and most importantly, how the market views it. Is it just one step and then we are back to the business, or this is first of the many steps that can follow? Because RBI waited for the festive season to get over before sort of taking this step. Second, they could have taken this step also on the policy statement, but they didn't wait for that. So clearly the discomfort has been there. We need to wait and watch and see how market absorb this in terms of the valuation multiples of some of the high-priced stocks.
No, I take your point. The warning came during the monetary policy, and the action has come just probably a week after Diwali or a few days after Diwali. So clearly the intent was there. They only didn't want to spoil the fun of Diwali, perhaps. Now, to come back to your earnings, time permitting, I'll come back again to this macro issue of whether it is only banks and NBFCs we have to concentrate, or whether there will be a general consumption slowdown and there is an overall, earnings or valuation impact. But first, in your earnings analysis, have the mid caps done better than the large caps?
I think, Lata, in terms of expectations, both have marginally beaten our expectations. Now, mid caps, obviously, the base was very low. So, in terms of the percentage growth, that looks very different. The magnitude of the percentage growth in mid cap is very high. But I would compare everything against what was in the price, what was expected, right? Versus expectations, large cap have also beaten. Versus expectations, mid cap have also beaten. The other important aspect that you need to remember is mid caps have rallied about 25 to 30% in calendar year 30. Their valuations are trading at a premium to Nifty and also at a premium to their own long period averages. So mid caps beating expectations marginally is well into the price already. It's already factored in. Of course, there are going to be companies on a bottom-up basis where you can still debate whether it's in the price or not. But broadly, from a very top-down perspective, mid caps have rallied well. Their valuations are at a premium. What is baffling is that large caps are trading very, very cheap compared to mid cap right now. In fact, I will go one step forward and say Nifty is looking very, very reasonably priced at this price to earnings multiple. And we are still talking about 20% growth full year FY24. This is coming on a high base. FY20 to FY23, Nifty earnings have compounded 23%. On that, we are talking about a 21% earnings growth for FY24. Some of the other macro parameters have also eased off. Crude is back in that 80 kind of a range from 95. Bond yields, both globally as well as US, globally as well as in India, have come off about 20-30 basis points. So a lot of the macro factors are easing. Earnings growth has been good and valuations are in your favor. And plus, we are entering that customary 6 months period before the election announcement results for the Lok Sabha. And we've done a detailed discussion with Surabhi on her inaugural show of Markets Cafe a few months back, where we discussed that every Lok Sabha election for last 25 years, 5 Lok Sabha elections, the markets have given positive returns 6 months into the announcement of the poll results in May 24. So history is in favor of a good pre-election market rally. Let us see whether it pans out this time or this time is different.
Oh, yeah, and we are getting some help from crude going to $77 and US yields also after a scare, now perhaps moving below the 4.5% mark. So, aapke muh mein ghee shakkar on that note. Now, let me come back to the rule that the Reserve Bank has brought in. Do you worry that you may have to bring down some of the earnings forecast? Because among your very good mid-cap performers, you also have M&M Financial, Credit Access and Angel One. Now, we know that there is a huge amount of volumes in equities, in derivatives, and some of it could be because of loans from NBFCs, if not from banks and NBFCs. So would you want to rethink any of your earnings as well consumption? I think among your overweight sectors is also consumption. Now, with cheap loans becoming less cheap, do both these sectors, do you think some earnings reduction or valuation reduction will have to come?
See, financials definitely, Lata, depending on how every company is placed, which segments they are in, and how do they navigate this latest change in capital risk weights. We'll have to see and basically wait for some time to relax as to how companies change their strategies segment by segment. As far as consumption is concerned, you pointed out very rightly that we are overweight and we are significantly overweight on discretionary, and we have just one staple stock. So if I remember, out of the 8 model portfolio stocks belonging to consumption that we have, 7 are discretionary stocks. Now, this particular step, I don't think it is going to have much of an impact on the companies that we have in our model portfolio. For example, Titan, Indian Hotels, Metro, Zomato, DMart, Lemon Tree, Kajaria. I don't think any of those companies get directly impacted by what RBI has done. So I'm quite comfortable owning those names. In fact, if there is any correction in those names, given the growth that is there, the underlying story that is there in those segments, I would be more than happy to buy them if there is any correction. As far as the mid-cap financials that I spoke about, Angel, we've recently added a month and a half back during the preview when we revised our model portfolio. We had added Angel back at 1900. That point of time, the earnings was about 14 times. In 1.5 months, the stock is up 55%. Yep. So obviously the valuation multiples have got re-rated. It is now trading at 21 times. But to remember that the equity volumes have been very robust. More importantly, Angel has been gaining market share month on month. So we are still very comfortable owning those names because the ROEs, payout, the underlying growth, market share, all those operational metrics are still very comfortable in that particular name. As far as other NBFCs are concerned, I think it is too early to take a view because we have to see how companies actually change their gears on growth. Definitely there will be some pullback there. Definitely there will be some earnings changes that will happen as we move forward 1 month, 2 months into this announcement. But let's wait and see how it pans out.
Okay. I take your point. This is the most interesting conversation. And the big takeaway that we have from Gautam is that after hearing that valuations are expensive in India, we hear some very solid arguments that actually things are reasonably priced because earnings have caught up, as Gautam has proven. Yes, speaking about hotels, you had Indian Hotels and Lemon Tree in your list. I can tell you, Gautam, I thought that with G20 over, the big business for hotels is perhaps tapering. And now you realize that the World Cup has actually given them much more business. I can tell you it is very difficult to find even a modestly or reasonably priced hotel room in Ahmedabad today. I know because son and husband have been fighting for it. Yes.
Actually, in hotels, Lata, it is not just event-driven plays, Obviously, G20, World Cup, all of this haven't helped. But the most important underlying parameter which is helping the hotel sector is that the supply growth is very feeble right now. Okay. Demand is growing at about 7-8%, while your supply is growing at 2-3%. And also remember that hotel has gone through an 11-year period of a downturn. And we discussed this in the past. There are 4 or 5 sectors. There have been elongated periods of downturn. And now all of those 4 or 5 sectors, auto, industrials, real estate, hotels, they are going to go upturn together for last 2-3 years. Possibly it may last another couple of years.
Got it. No, your buys and your upgrades are all running even as you speak. So thank you very much for that, Gautam. We have also one eye on the weekend and the hotel rooms that we have to book in Ahmedabad. That's the only reason why I brought it in. Thank you very much for being with us on Bazaar. We have to go into a break and Chartbusters will come up next.